Welcome back to Hash Commerce and Dollar Accounting. In today's lesson, we're diving deep into asset disposal and impairment, a crucial part of accounting that every business needs to understand. When a business no longer needs an asset, it must remove it from its books. This process is called asset disposal, and it occurs in three ways: sale, discard, or exchange. Imagine a company bought machinery for $50,000, and after 5 years its accumulated depreciation is $30,000. The company now sells it for $25,000. First, we find the book value. Book value equals 50,000 minus 30,000 equals 20,000. Since the selling price, $25,000, is higher than the book value, $20,000, we record a gain on sale of $5,000. Dr. Cash, $25,000. Dr. Accumulated Depreciation, $30,000. CR, Machinery, $50,000. CR, Gain on Sale, $5,000. If the selling price was lower, say $15,000, then we would record a loss on sale of $5,000 instead. Dr. Cash, $15,000. Dr. Accumulated Depreciation, $30,000. Dr. Loss on Sale, $5,000. CR, Machinery, $50,000. What if the asset is obsolete and cannot be sold? Example: a company throws away a machine with a book value of $10,000. Okay, so for discarding an asset, here's what you need to know. First, you debit accumulated depreciation. Then, you debit loss on disposal. And finally, you credit the asset. The key point here is that if an asset has no value, the remaining book value becomes a loss to the company. Alright, let's talk about an asset exchange. Imagine a company exchanges an old truck, which has a book value of $12,000, for a new one that's worth $20,000. In addition, the company pays an extra $8,000. Now, for the journal entry in an asset exchange, you would debit new truck for $20,000, and debit accumulated depreciation related to the old truck. You would then credit the old truck for $12,000, and credit cash for $8,000. When an asset's value falls below its book value due to damage, market decline, or obsolescence, we must recognize an impairment loss. A company owns a building with a book value of $500,000, but due to a real estate crash, its recoverable value drops to $350,000. Impairment loss calculation: 500,000 minus 350,000 equals 150,000. Dr. Impairment loss, 150,000. CR, accumulated impairment loss, 150,000. Important: unlike depreciation, impairment losses are not reversible under IFRS. Asset disposal happens when a business sells, discards, or exchanges an asset. Gains or losses depend on the difference between selling price and book value. Impairment occurs when an asset's value permanently drops below its book value. Comment below if you have any questions or need further clarification. Subscribe to Hash Commerce and Dollar Accounting for more in-depth commerce and accounting videos. Like, share, and hit the bell icon to stay updated. See you in the next video.